Good afternoon, everyone, and welcome to Compeer's webinar on scaling your back office operations. Now, the UK wealth industry has performed remarkably consistently over recent years, even when it was faced with the pandemic. And year after year, it's delivered record levels of revenues as both businesses and asset levels have continued to grow. However, rarely do we see margins improving at the same time. And so it raises the question, is the industry as a whole or are the individual firms actually scalable? And much focus is often given to the productivity of the front office and how that then impacts the firm's results. However, today we wanted to switch the focus to the back office to see how improvements in this area could positively influence a firm's both individual performance and their ability to be scalable. And today I'm delighted to be joined by two guest speakers who are each going to be presenting for approximately 10 minutes. And then we'll finish the webinar with a wealth management panel discussion. And as with each of our webinars, if you would like to pose a question to any of the panelists, please do use the Q&A button at the bottom of your screens, and I'll look to get as many of these questions as answered as possible. So let's get cracking with our first presentation, and I'm delighted to welcome my colleague Tom Thwaites, who's today going to be sharing some of our key data relating to back office spend and scalability, and most of which has been taken from our annual benchmarking survey. So very much welcome, Tom, and I'll pass over to you.
Thank you, James, and thank you all for joining us today. My name is Tom Thwaites. I'm part of the analyst team here at Compeer, and today, as James mentioned, I will be using some of our benchmarking data to highlight the key pain points when it comes to performance of the back office and some of the common problems we see with scalability. So if we move on to my first slide here, we have a brief overview of the industry. Now, before the pandemic, the industry was a picture of health, continuously breaking records in performance measures such as assets, revenues, and absolute profit levels. And despite the impact of the last 18 months, the industry has performed remarkably well. Total assets now stand at 1.15 trillion, having risen by almost 9% in the last year, following the market recovery and high asset inflows. Off the back of strong asset growth since 2016, revenues have increased 19.8%. However, costs have risen at a higher rate as margin compression continues. Now, these cost increases will be a key theme throughout my presentation, as the nature of these has largely been to invest in more technology to enhance the way firms are run. With scalability so hard to come by in the industry, will this lead to a boom in the number of firms who can efficiently scale up? Well, if you move on to my next slide, we can take a closer look at IT and operations data to understand the issues of scaling the back office. Now, despite strong revenue growth in this time, averaging almost 4% per year, the amount firms spend has outgrown this, as both IT and operations costs as a percentage of revenue have slowly been going up each year. While staff costs are often the source for many problems for the front office, as firms compete to attract and retain the best talent, here we can see from the figures on the left that for the back office, it is the non-staff costs which have risen the most. Again, these figures are stated as a proportion of revenue, with IT non-staff costs rising the most from 4.5 to 5.7%. While staff costs have been managed more effectively in relation to the revenue growth, as the two figures have remained fairly flat since 2016. If we move now onto my next slide, we can see how these cost increases have impacts with the battle with scalability. And by Compeer's definition, we class a firm as scalable for a given year if they are both profitable, both their revenue and their profit margin increase. For many years now, the industry has a track record failing to scale up as a collective, with the average rate around 40%. However, 2020 has been very successful, resulting in a jump in the number of scalable firms, largely due to strong revenue growth of 5.6%, which was up from 3.3% in the year before. Now, if we look at the table below, we have the consistency within the industry when it comes to scale. Here we can see the number of wealth managers who were able to scale up in each of the last 5 years. And what stands out straight away is the fact that despite the healthy market conditions, during this period, 16 firms were not scalable in any of the last 5 years, while only 2 firms were able to scale up in every single year. The majority have been able to scale up in a couple of years, but most have not been able to consistently grow their business while effectively managing their cost base. To see where the problems lie, on my next slide, we can take a closer look at the underlying figures for these results. The diagram here compares the 3 points we use to describe a firm as scalable, so profitability, revenue growth, and margin improvement, to show how wealth managers have developed from 2016 to 2020. What we see that from the center is that only 37% of the industry has been scalable over this 5-year period. Since 2016, firms have struggled the least with profitability. Wealth management is known for its high profit margins, where the current industry average stands at just over 22%. However, the spread in this does vary, with 10% of the industry making over 40% margin, while almost 20% of the market is making a loss. While I appreciate that profit margin may not be the main performance indicator wealth managers look for to keep clients and shareholders happy, however, from a scalability standpoint, it is definitely a cause for concern. Next, we look at revenue growth, which has also been largely successful. Here we find that 81% of firms have grown their revenues since 2016. The issue for many lies with the ability to increase their margin each year. And since 2016, only 46% of firms have been able to do so, largely due to rising costs and downward pressure on fees. So what needs to change in order for firms to become more scalable and to increase their margins? Well, on my next slide, we can have a look at one possible solution. While there may not be a holy grail which can solve the industry's scalability issues in one go, outsourcing could be a big step in the right direction. However, the current level of outsourcing spend remains very low. Figures show consistently in and around just 3% of total costs are spent on outsourcing. To put this into perspective, in 2020, all wealth managers spent a total of 5.95 billion. Of this, just 208 million related to outsourcing costs. The issue outsourcing providers have is that the majority of firms are very well established and as such are set in their ways. It would therefore take a substantial overhaul for these firms if they were to embrace a new outsourcing model. On a more positive note, from speaking with firms, we found the consensus was that if they were to start a wealth management firm from scratch now, the majority would choose to outsource many of their back office functions. With an outsourced back office, these firms would hope to reap some of the benefits, which we'll see on my next slide. To see some of these benefits, I've compared the key performance metrics between firms that already outsource and between those that are fully in-house. The first thing to note this was a period of strong growth for the industry as a whole, and as such, the weighted average asset growth levels have been very positive for both groups. The outsourcing group, however, have achieved slightly higher level of asset growth, a difference of 8%. However, revenue growth was substantial, 23% higher than the in-house firms. The trend also continues when we look at scalability. In 2020, the outsourcing firms lead the way, with 64% having scaled up from the year before, compared to only 51% of the in-house group. And just to clarify, I'm not necessarily saying the direct cause for the additional growth is because firms outsource. There will, of course, be many other factors that impact the growth. However, I would say these results provide evidence to suggest outsourcing definitely can support growth and assist firms as they scale. And when we look at the final measure, the in-house firms have a much greater weighted average profit margin, 7% higher than those who outsource. A noticeable gap which was as wide as 13% in 2018. Now this gap may have closed, but there is still some way to go for the outsourcing firms. In the case of the outsourcing group, it is among the larger firms that have been less effective at cost control and maintaining large in-house teams. Therefore, they have driven down margins for the overall group. If we look at the total number of IT and operations staff per £1 billion of assets, we find that both groups have comparable numbers. Logically, we would expect to see the firms who outsource to have far fewer in-house staff in their back office. However, this is often not the case, as these firms are missing out on one of the key benefits to outsourcing by maintaining an in-house team that would be sufficient to run these processes themselves. I appreciate that some in-house staff will be required for these departments to monitor the systems and to maintain the relationship with the outsourcing provider, but it appears some firms are spending far more than necessary by overcrowding their back office. This is why the cost of some of these outsourcing firms are so much higher and their profit margins are much lower. They're essentially running an outsourcing project while also paying for a similar sized in-house team. And now, moving on to my final slide, we can take a look at how these two groups compare over the back office costs. While costs may not be the driving factor behind the decision to outsource, it will certainly be a key consideration. Now, what I've done here is look at the total IT and operations costs and taken them as a percentage of revenue and per £1 million of assets. I'll highlight that these are total costs and not just the cost of outsourcing, so they'll include any other in-house costs in these departments, as well as non-staff costs such as information services, IT hardware, systems, and then any other operational non-staff costs. And as it stands, it looks like the costs are higher among those who outsource. For example, there's a 3% difference in the weighted averages for costs as a percentage of revenue, and then a 5% gap in the median values. Whereas on a per £1 million of assets, the weighted averages for the two groups are almost level. However, the median and upper quartile values for outsourcers are significantly higher. Now, overall, I think that the costs for the outsourcing firms could be significantly lower than they currently are. And it's not that outsourcing is always overly expensive. It's more so that not all firms are fully capitalizing on the benefits of outsourcing, which is what is driving their costs much higher. So that concludes my presentation for this afternoon. I'd just like to say thank you all again for joining us. I hope you enjoy the rest of the webinar, and I will pass back over to our host for today. So over to you, James.
Well, thank you very much, Tom, for those insights. And I should mention that we will be sharing the slides after this webinar, so you by no means need to memorize all of those stats that Tom just shared with you. So we now move on to our second speaker, and given the view from the supplier side, I'm very pleased to welcome Jim London from SEI to give his views on how scalability can be achieved in the back office. Very much welcome, Jim, and over to you.
Thanks. So yes, I'm the Chief Operating Officer for SEI Europe. SEI is a global provider of both asset management and outsourcing and technology solutions. So we have some experience working with banks and wealth managers globally to help scale their operations, and also to focus on scaling our own operations to provide those services. I think we also operate our own sort of buy, build, and integrate approach. So we in turn will do outsourcing where appropriate, and we'll source technology where appropriate. So we have some experience on both sides of the play. I thought I was just going to try and, given the limited time I have, I thought I'd just try and give you a few insights into some of our experiences and our approaches with wealth firms, both here and globally. So perhaps we can move to my first slide. And again, this is a fairly standard model, but what you'll see here really is sort of the conflicting elements of trying to achieve scale. And I think when I think about scale, we're looking at trying to create the capacity for growth and trying to create a model, to some of Tom's points, that is profitable and effective. We're not looking to create unused spare capacity, if you like. We're trying to use a model that is effective. And I think what we've seen working with firms is that the first thing to do is, when you're looking at the existing model, is to really study and analyse all the aspects, the push and pull factors in that model, because it is quite easy to jump to the too many people, legacy technology detail, and look at those costs. But I think what we've found historically is, I'm sure you're all aware, if you look at the true nature of the operations, the back office is generally there to process what they're given to process. They're not looking to sort of process things for fun. So where you've got multiple propositions, diverse client offerings, legacy terms and conditions, all the stuff on the right of the picture you can see on the screen is all the stuff that mounts up and builds up, and you get that classic service creep and complexity. So really sieving through the detail and sieving through some of the content of the propositions, both current, historic, and future, and understanding what the impact they're having on the operating model is critical, because there's no point trying to scale elements that are out of date, out of touch, and aren't going to be there to support your future proposition. So we spend a lot of time with firms going through that model, challenging the current model, and really trying to understand, what is the true cost of operating, and what is it we need to do collectively to deliver scale, to really to provide that growth opportunity. Because the stuff on the left, generally there is always development and progress in technology. We can always leverage things such as robotics to plug in the gaps and create automated processes. But really, it's about trying to understand the objective and the target, if you like, of that scaling operation. And this is always a critical factor in what we try and do. The second part of that, and a really important part of that, is leadership. And I think, again, we shouldn't underestimate the importance of leadership in any attempt to scale operations and trying to streamline or improve or enhance the back office. We've all seen there's always a certain amount of sort of ownership, if you like, of legacy technology is always someone's baby. Operations is always quite precious, and sometimes rightly so. And I think we always have work with firms to try and work out, what is the leadership doing to take the propositions that the front office have come to know and love, versus the reality of trying to create an efficient or scalable back office, and trying to find that middle ground, that balancing act between continuing to deliver what customers want, but also trying to enable, if you like, a transformation of the back office. Because invariably these lead to big decisions. I think if we look at some of the outsourcing stats and even some of the technology stats, it is a challenging and not insignificant decision with material impacts on a number of individuals. And those decisions aren't taken lightly, and they really need to be factored in and thought about in terms of the overall impact. So I think really the key thing here is to correctly and properly and in depth assess the current situation, and to really look at what you mean by scale. What is the objective of that scale drive? And is the leadership aligned, if you like, in terms of what compromises and decisions need to be made? And they are some key elements in the whole conversation around scaling the back office. If we move to my next slide, and you'll be pleased to know I only have two, and you can probably also tell the slide that I drew versus somebody else, because this is my, I think rotating a pyramid was about the extent of my PowerPoint skills. Really here, I just wanted to focus on a bit more, how do we get into a bit more detail? And I would say, if you look at the models that people have historically, it's very easy to build up, as I said, on the left, that sort of legacy model of a whole host of bespoke processes, manual process, and then some STP and some global processing. And some of that may need to be retained, but the rest of it maybe not. And I think what we try and drive to, and certainly when we work with firms, we always try and say to try and look at that and say, try and process things at the highest point possible. So if you're looking at an outsourcer or even a technology vendor, will they allow you to process things at the highest point possible? So, what can you process globally? What can you process at the regional level? There are things that you do across propositions, be they corporate actions, reconciliations, etc. Anything that can be done where the proposition, if you really cut to the chase and look through the process, doesn't really matter. If you look at a fee can be applied, the fee can vary, but a fee application is a fee application. How can we try and take those processes and drag them up to the highest point? Because I think in my experience, people get a bit hung up on STP rates and on automation and where can I plug in a robot. But I think the building blocks are to get some good solid, put the process in the right place first, try and automate the process, and as you work your way through it, but put it in the right place to start with. So certainly I would encourage people to look at the processing layers and the model and find out where that outsourcer, at what level can they process things to get the most effective model and the most scalable model. Again, if you look at things like the proposition side of things, then again, look, we know that firms have wealth propositions, managed portfolio services, direct to consumer, robo applications, and again, I think there's got to be an aim there to process consistently. I think one of the key aspects that we look for is to say, you can put all your variation at the top, but all your variation on the inputs. We know that you have to integrate, and we have to integrate to a number of third-party tools. People have their preferred tools, their CRMs, their client interfaces. So make sure that the provider is open at the front end, but then directs traffic, if you like, into a very standard process, and then allows variation on the back end. So you do it through inputs at the front end, configuration and output, not through ending up with 5 different processes, which again sounds fairly obvious and straightforward, but as we all know, you surprisingly build up a number of parallel processes, just really hamstring any attempts to reach scale. So I think, you know, they are some of the aspects that I think we need to bear in mind. And I think the aim for us is that working with firms and wealth managers is that, you know, there's always some manual things that you need to do. There is value in some of those manual things. I think the key thing that we've found is really for the wealth managers to look at the, you know, what is the true value, not necessarily something that the front office have always done and always sort of like to do. But is there real value in those? Are they part of the client's proposition? Are they the reason the customer is signing up? And then put the manual process and focus and the controls, more importantly, around those manual process in the right places against those value add aspects, so that you move more to the model on the right, where you've got as much high level global SVB, and then you've got value where you're manual. So they are really, you know, again, got the high level aspects of how we like to approach operational scale. And then I think finally, just one thing to bear in mind is that, as we know, there is ever increasing focus on resilience, and I think sometimes in a drive for scale, there's a keenness to create one end-to-end STP process that is a straight through and is highly efficient. We had to look in the pandemic ourselves, for example. We were juggling operations across the US, India, and the UK, and we had a certain amount of overlap, if you like, and a certain amount of resilience and buffer built into those operations. And if we'd streamlined those to the full effect, we may have been under more pressure, because we gave ourselves that capacity to try and cope. And I think, again, there is a nod to resilience here, and to say that, you know, the aim isn't to create a straight through skinny process that leaves you vulnerable to those key components. So we tend to recommend or talk to firms about having some resilience, some robustness, in some cases more than one custodian, in some cases, you know, more than one platform or payment methodology, so that you've got that buffer around the resilience. So it's just, you know, there's always that, and certainly from a regulatory point of view, that is something that, you know, that is now expected and is increasingly observed and challenged. So we would suggest that building that into any scale process is absolutely critical at this stage. I think I've probably whistled through that, but I was conscious of time. I've hopefully given you a little bit of a high-level flavour into how we approach things, and certainly, you know, the things to observe and think about around outsourcing or technology provision. And I will hand back to James at that point. Thank you.
Well, thank you very much, Jim, for that level of detail and for sharing your experiences. Well, that brings us nicely onto our panel discussion. And today I am delighted to be joined by three guests. And so, providing the view of the wealth manager, we have Tony Hanlon, the COO of Wealth at WH Ireland. Then the voice of the supplier is provided by Tom Wooders, the head of sales, clearing and wealth solutions at GPP. And then finally, we have Paul Stallard as our industry commentator, who's worked in banking and wealth management throughout his career, co-founded 2 fintech companies, and is a director of the Centre for Digital Banking at the London Institute of Banking and Finance. Well, very much welcome to each of you, and thank you for joining us today. And so I'll get started with our first question. And Tony, if we start with you on this one. Now, we've seen from Tom's figures that actually there's a large proportion of firms in the industry who are not delivering scalable results. And in fact, other research has indicated that scalability has very little correlation with the size of the firm. So there are some very large firms who still aren't delivering scalable results. And so if we focus on the back office, what would be your main changes that you would implement to make a firm more scalable? So that's Tony, please.
Hi everyone. The number that twigged in my mind as Tom spoke was the 22% margins, which despite what you hear at some of these conferences, we're not a particularly margin stressed industry, and what that leads to is a bit of a mentality that I daren't break it. And so what you tend to find in back office operations is that they've kind of found a way to work either by sort of trial and error or inheritance that keeps them out of trouble, keeps the error rate low, and doesn't break the system, and that's success. And actually coming in with a sort of big bright idea to change it significantly worries people. And actually, as you said, people focus on the proposition and selling more stuff, but what they want from their back office is 100% reliability, low error rates, and there isn't actually a massive cost pressure to drive that down. So I think that mentality is probably the biggest driver. The other change I would make is, as Jim touched on, is the siloed issue where Adam Smith was spot on with his pin factory in the 1700s, but he's not quite spot on today in that if you silo activities into really small pieces, it achieves that first aim I mentioned in that people become really good and they don't make errors and so forth. But it isn't very easy to change it or to change its volume without just adding more bits to each element. And I think the more you can cross-skill, the more you can employ people with a different view of the world without breaking it, that gives you the opportunity to start to see the world slightly differently.
Thank you, Tony. And Tom, are there any other changes that you would implement?
Yeah, I think what we've heard so far really, quite interesting, picking up on both Tony and Jim's comments to a degree. How do we define scale? I agree with Jim. It's the capacity for growth, or perhaps thinking back to what the other Tom mentioned. It's scale really in my mind refers to the ability to grow one's business without a disproportionate increase in cost. So it was interesting to see some of the metrics that were presented earlier, and how some of those costs actually seem to have gone up through a full ops outsourcing. So I wonder, maybe echoing Tony slightly, whether the question is more around not whether a firm itself is scalable, but whether the proposition and the processes within that firm need to be more scalable. And I think it's probably something we'll get onto in this discussion. But for me, probably the keys to that are, again, mentioned earlier, but integration. I think it's not just back office. I think it's that whole front office, middle office, back office integration is kind of key to the achievement, I suppose, of if nothing else, then consistency and quality of process, and perhaps automation as well. And I think there's other factors involved as well. I think if we go back to the definition I gave around facilitation of growth, then perhaps it's how could a firm look to achieve greater service quality? How can it achieve a better quality of product, if I can call it that, in an investment context? Which net result, as Tony was saying, maybe it's not so much margin related, but it's certainly related to what is the productivity we're achieving from the resources we have today. What are our metrics around client satisfaction, retention of clients, and perhaps even the ability of a firm to attract a greater share of wallet. So those would be my sort of key touch points on increasing scalability, I think.
Okay, and Paul, is there anything you would like to add? I don't know if you're muted or something, Paul, because we can't hear you currently.
I do apologise. I swore to myself I wouldn't do that again, so sorry to everyone. What I was saying was that I do agree with Tony and Tom in the sense that there is a mentality issue here in the back office, and one that you have to be very careful of. You clearly don't want to sink a ship for the sake of creating too many waves below the waterline, so to speak. But there are certainly pain points or issues and challenges within the back office that need attention. And it could be by involving the back office, involving all those people around the challenges and the pain points, and looking for alternative ways of doing it. Now, if that's about education, or as Tony said, that's about bringing new people into the business, then so be it. But as soon as they taste that success, it becomes a good thing, and it can spread into other aspects of the process. And I think more than anything, they need, in back office, our colleagues need the comfort that you're not going to do it too quickly and too unerringly. You have to be very careful and prove it works. And when you get to the point, if indeed the decision to tackle a particular process is make, build, or buy, if it's a situation where you partner an organisation, you must at all costs make sure you can trust that organisation. They have to be trusted partners. They have to be in the camp, and you can only do that over a period of time. My big message is don't rush it. Be very careful and very measured what you do, because you could spoil what you've got.
Thank you, Paul. And I'll stay with you on this one. So can any lessons be learned from other industries, such as the luxury goods, obviously, which are targeting the same clientele as well, maybe even asset management, as to how to better achieve scalable results?
Well, yes, in many ways. Learning how to make swift decisions and having an agile mentality about what we do. And again, that isn't something that's achieved overnight. You have to practice that process of making quick decisions and failing fast sometimes, so you learn. And that engenders a whole new mentality among the people you work with. It's really, really cool. From my personal point of view, the most important thing in this process is keeping close to customers and understanding customer sentiment at any point in their journey. I'm fond of building products and services for banks and wealth management companies, and I can promise you I spend 60 or 70% of my time in the back office, making sure that what we're promising to do, we can actually deliver. And sometimes when I'm looking for good ideas, I go and ask the back office people, because they're the people who know exactly what customers react to positively. So there's a big issue there about keeping very close to customers. It's not a front office issue. It's an everyone issue. It's front, middle, and back office issue, and one that must be shared.
Thank you. And Tom, do you believe there are any lessons that can be learned from other industries?
I think I would also choose probably to answer it from maybe not other industries, but other segments of our own financial services industry. Having personally worked across not just the wealth management sector, but also in the institutional asset management space, and also on the sell side. It's interesting, I think, to make those comparisons. As Paul says, a lot of this is about not disrupting what is already there. I think those other sectors of our industry, they've seen their own experience around outsourcing of back office. The sell side probably has gone the furthest, because they probably have said back office outsourcing was a given 20 odd years ago, but that's gradually extended into sort of trading and settlement as well. The institutional asset managers, perhaps it's more focused around middle office and investment operations and fund administration and that side of things. But I think where perhaps there are some idiosyncrasies, certainly from a wealth management standpoint, is the back office is obviously fundamental. It's the underpinning of everything else that's happening. In firms perhaps where outsourcing has taken place, it becomes that sort of black hole in the infrastructure of the firm, and if the firms aren't careful, they can lose some expertise in that regard. I think another challenge perhaps is that it's a very diverse segment of the industry. So wealth managers, I think somebody mentioned earlier, you could go from pure discretionary bespoke through to advice-driven MPS, through to EXO, trust companies, robo-advisors, you name it. There's a whole multitude of different flavors within that. So actually, I'm going to echo Paul's comments, which are that the focus on growth through outsource. I think you cannot lose sight of both staff buy-in internally and leveraging the skills that they have, but equally I think it's the end client engagement as well. And I think depending on who the wealth management firm is in question, a smaller firm, and how do we define that, but let's say less than 2 billion of AUM, arguably I think they're looking for something more nimble, because they're in that growth mode, and that's where I think the requirements for sort of flexibility and maybe even modularity around the pieces that they might consider outsourcing come into play. So I think it's very much horses for courses in some respects.
I think, if I may, this probably isn't something anyone wants to hear really, but if we point to an example of Hargreaves Lansdown, I worked with Peter and Stephen for 3 years or so, and their issue is such that they weren't such a magnificent company overnight prior to their flotation. They had 25 years worth of experience in building their internal back office processes to make them the doyen of the wealth management world. And that was a long time, but the focus and the concentration of those two leaders on back office was huge. It was monolithic, and they spent more time in the back office, middle office, than they did at the front of the business. and that's largely the reason for why they are so good.
Yeah, and I equally wouldn't understate it, because GPP has been going since 08. The back office platform was actually, it began development in probably 05. So we know what's involved in building one of those.
Exactly.
Sure. And Tony, from your experience in other industries, do you think there's anything that wealth management can learn from them?
Yeah, I think luxury industries always tend to, if you take it all, pretty much all industries are a battle between sales who want to bespoke everything for each customer and ops stroke delivery who want everything to be exactly the same. And luxury industries do tend to drift more towards the bespoke end, but what the good ones tend to be good at is being very clear at where they add value. And to give a very simple example, and I'm not sure whether soft drinks really count as a luxury good, but if you think you were going to sell soft drinks, you'd think, well, okay, I need some sort of quality ingredients. I need the process to build the drink. I need something to put in a bottle, and I need a way of distributing it. If you then think about probably the most successful soft drinks retailer of all time in Coke, they don't do any of those things because they've worked out what they're good at, and what they're good at is brand and marketing. And they stopped doing all of the things, apart from basically protecting their recipe, they stopped doing all of the stages in the middle, which they could outsource or localize or partner or franchise and so forth. So my message would be very clear, or the successful firms are very clear in where they add value and therefore stick to that part.
Thank you, Tony. Now, we've seen there's, looking again at the Compeer results, if we look at some back office efficiency measures, so like assets under management or portfolios or transactions per operation staff, the variance across the industry is vast. I mean, it could be to some extent where the best ones are 4 times more efficient than the worst performers. So really the question is, why do you believe that there is such wide variation, and what are the main issues facing the back office? And I'll stay with you, Tony, on this one.
Yeah, I mean, I sort of, if I continue my example, a lot of our industry are recovering stockbrokers, right, who are moving to a wealth positioning, and that makes it very hard to become the Coke of wealth management, because your core health, WH Ireland's case, have been around for 200 years as a stockbroker and 5 years as a wealth manager. To sort of give up on the stockbroking element is sort of putting the firm through cold turkey. So you do, to the legacy position, I think, is probably what's defining most of your X to 4X variation. And we already mentioned that, that reluctance to break it and that reluctance to change it. If you've spent a significant period of time making reasonable margins out of stockbroking, then to let that part go and to focus on wealth, which let's face it, is the client contact part, is probably a big tear off of the band-aid, right? So I think the other point is around, and both the other two speakers touched on this slightly, is around those aims, and the incentives for our back office teams. And profitability probably isn't their number one incentive. Actually, as I said before, error rates, not sinking the ship, etc., probably is. And so, how do you give them the right to make mistakes and change is probably a managerial mentality or a firm culture. Again, I suspect if you look at your the deltas across those firms on some of those things, you'll find that the firms that are willing to experiment or in a position where they can afford to experiment have probably got the greater improvements.
Thank you. And Tom, would you agree, or do you think there's other reasons why there's such a wide variance in back office efficiencies?
No, I kind of do agree actually with what Tony said. I think, and maybe we see it from a slightly different perspective. It's interesting to hear WH Ireland's sort of shift in focus, but we've really sort of established our wealth services platform off the back of our back office. As I said earlier, that was the mainstay of what GPP was doing back in 08. And over time, we've really integrated the sort of the middle office administration and the front office client digital piece above that. And in so doing, I think, it's sort of interesting, the variation in terms of the types of firms that come our way. And absolutely, stockbroking is alive and kicking. I think there's a lot of change in our industry right now in terms of some of the the ways in which firms are sort of either retrenching or extending their product offerings. But I think it's important to those firms that they can find providers who are willing. I think we're sure we'll get into this, but as a not the monolithic approach where one size fits all, but actually where there's an ability perhaps on a modular basis to support those different functions. So I think in that context, I think the measures aren't just AUM portfolio growth. I think it's still the productivity piece that has been mentioned. But I think it is also transactions throughput, STP, as was mentioned earlier. I think it's levels of exceptions and exceptions mitigation. And I think what the industry is really sort of looking for there is the ability to address those different aspects, but in the same sort of common ways, which are process consistency, replicability, perhaps the quality of some of those processes, and again, I say it again, but I think the back office in what it does needs to be fully integrated to those other pieces to be fully efficient.
Tom, would you say that what we saw in Tom Thwaites' numbers was perhaps more an indication of where we are as an industry with regard to technology adoption, and that we're actually, what you're seeing there is some technology catch up rather than a steady state variation with size? And so I immediately looked at what Tom Thwaites showed us there and thought, the fact that it went from 4 to 5.5% on IT wasn't a reflection of an increase in AUM. It was a reflection of the fact that we weren't spending enough on IT in the first place.
I think you're right. I think going back to something we were asked before, I think the relative spend in wealth management, to my point earlier about other parts of our industry, asset managers are very used to outsourcing middle office to the big middle office platforms, the big accounting platforms. The sales side, as I say, absolutely the same. There is definitely catch up here. Is it all legacy versus modern? I think in part because I think client demand has changed, and especially post-COVID, I think the whole digitization piece is only going one way. I think there's the whole reg tech arms race as well. So I think that's definitely part of it. I wonder whether another piece of this as well is what I termed earlier the investment product, i.e., are we seeing that sort of shift within the platforms that firms are adopting, where increasingly perhaps there's adoption of MPS and those types of approaches, or more passive ETF investment to kind of counter some of those rising costs that the other Tom talked about.
Thank you, Tom. Now, also, we mentioned outsourcing quite a few times, but the figures show that currently very few wealth managers do actually outsource. So start with you, Paul. Why do you think this is the case that so few are currently outsourcing?
Well, I think, as Tony said very early on, there's a huge fear of change in the industry for very, very understandable reasons. There's a fear of messing up the regulatory requirements, and once bitten, twice shy in that respect. And I have every regard for anyone who's gone through that process, because I'm sure we all have. I worry about how many multiple systems there are in the business, and the difficulty of getting data between systems, and if businesses are geared up to do that efficiently, effectively. And outsourcing is not easy. It requires a lot of attention, not by one or two people, but everyone. Everyone has to buy into this process. It has to be led, to Tony's point at the very beginning. You have to have a very strong leader who's going to drive this. It isn't the flavor of the month. And everyone who is affected by whatever change is happening has to buy into this process and be very with it. The challenge there is not everyone is terribly tech savvy, as we've been talking about. So that requires a learning process to bring everyone up to some level of understanding. I do a lot of work in banks around that in the product management sense, where I'm working with a bank now that hasn't had any formal product training for 10 years. And that's horrendous when you think about it. It's dreadful admission. And what they're trying to do now, because there's been so much movement, and continues to be, is bringing everyone's knowledge up to a level of common understanding, let alone the process they use to make products. It's interesting that a wealth management practice asked me not so long ago to help them and help everyone at the front end of the business develop more business. And what it was a relatively small business, I agree, but what was expected of me, I discovered after the first day, was that I was literally going to deliver names, addresses, telephone numbers, email addresses for these wealth managers to follow up. And what they didn't really want to do, and this was a palpable thing, they didn't want change. They didn't want to work any harder than they have to work already. And I found that very sad. And I'm really not the kind of person, and I don't have the capability or the willingness to do that kind of work. But it shocked me in a way. I thought we were long since out of the days when someone really thought like that. And the only way they were building businesses is by recommendation. Well, you won't grow very quickly, won't you?
Thank you, Paul. And Tom, obviously, you'd love to see more firms outsourcing currently from a GPP perspective. So why do you think it's the case that so few currently are?
I think we need to be careful just to delineate, there's I suppose my point really is there's different types of outsourcing. So I think, back office outsourcing, is a well-trodden path. And I think there's some obvious benefits, which we can talk about later in this discussion. I think the full BPO model is much newer in the wealth space, and maybe, less proven, dare I say. And I think, what might be some of the comments I receive from firms I speak to when that sort of concept is floated, some of them I don't think will surprise anyone. It's things like loss of control, loss of flexibility, the risk around, disruption or even migration risk. I don't think we should underplay that to one of the Paul's points earlier. And then I think there's some, other interesting feedback I've certainly received when talking to firms that have considered that option, which is, is their ability to influence the future direction of the platform they're using reduced because they become one amongst many. I think there's a worry, to one of Paul's other points, that, you get into that sort of, in a full outsource operation, you get into a kind of dependency culture where you lose those skills and it's very hard to regain them if you want to then reverse that decision. So, I think all of those come into play. And I think, with BPO as well, this is what I've certainly seen in sort of the other sectors I mentioned, sell side, for example. Effectively, you end up as the next client of that BPO outsourcer, you're buying somebody else's back office, which, how attractive is that? Because I'm sure Tony would agree, in the wealth management space, it's highly competitive. And I think another, perception might be that you could potentially see a dilution of competitive advantage if you go down that route. So I think there's many reasons, whether justified or not, in the wealth management space that have limited that take up of a full ops outsource.
Okay, and Tony, if I slightly rephrase the question for you then, what do you think the outsourcing providers are doing wrong or need to improve on to encourage more to outsource?
Yeah, so maybe I can link the 2 points. If you take my Adam Smith example and combine it with Jim's triangles, as Tom mentioned, that there aren't going to be many firms with the risk appetite to take that right-hand triangle and go, right, let's outsource the whole lot, let's do it. And that's a big ask for anybody that's currently making 22% margin, right? So I think that's unlikely. What I think they have to do is take a look at that left-hand triangle and work out how you can, and some of them are very good at this, right? The Trojan horse type approach, right? Sell 2 or 3 things that are good and get wider. But I also think we've got to remember, when we say outsourcing isn't really used, you think of most smaller firms outsource absolutely everything, right? They don't do even their own payroll or HR or anything, right? So as firms grow, there must be this either natural tendency to start thinking, well, I'm better at it, and therefore I need to bring it in-house. Or actually, in certain cases, I think the outsource model doesn't scale particularly well. And certainly in our industry, where we have this tendency to sort of price on a percentage of assets basis, actually you're fixing in a rise in costs if you do well. And I think all I can suggest there, and my experience from other industries, would be that you have to be very open and candid in your discussions with your potential providers, and actually that comes on both sides, right? You've got to go into that discussion and say, well, everyone goes in and goes, oh, we're going to grow the firm by 2 billion every year. And of course, the outsourcer looks at it and goes, maybe you will, maybe you won't. I don't want the downside risk. Maybe the firm should take the downside risk if they fail to grow, but equally what the firm doesn't want is to give all that money away if they do succeed. And I think that's, I think there's probably a pricing point in here where we need to be very open with each other, and then reward those who take the risk, but also reward those who do the work.
Can I just pick up on that, James, quickly?
Of course.
I would echo that point. The point that Tony made there around, again, it's a diverse industry, and the smaller firms, as I put it earlier. Yeah, I think you're absolutely right. We would always approach that as we will give you commercial incentives to grow your business. That's definitely our approach. Maybe another reason is that historically this has been a lack of choice. Maybe some of those larger incumbent outsourced providers that their sort of thresholds in terms of AUM and revenue have been a disincentive to taking that risk.
Okay, so if we flip it now and look at more of the positives linked to outsourcing, obviously naturally cost reduction is going to be one key element, although from figures we've seen before, it's not necessarily coming to fruition in a lot of cases. But what other benefits do you see from outsourcing? And I'll start with you, Tom, on this one.
Yeah, I think a lot of the things we've discussed. So I think absolutely the facilitation of scale, and whether that's through operational gearing, whether it's, as I mentioned, the replicability and the reliability of process, or resiliency, as Jim put it. Other, I think classic answers to that would be insulation from regulatory risk, as per Paul, the tech arms race that I mentioned before, and the classic, focusing on core revenue generative activity, i.e. client engagement. I think ideally, it could be margin benefit actually to the wealth manager. And it certainly probably should be some benefit to the end investor as well. I think everyone mustn't lose sight of that. I sort of almost see it as in that respect, quite a simple one, that firms that outsource really are looking in many aspects to convert fixed cost to variable. So there's that sort of cost predictability as they grow their business, so that they can compare that against everything else that's happening in their business. And again, I think Tom Thwaites' presentation really interesting to see that the IT ops costs as a percentage, they haven't gone down in a context of ops outsourcing. I'd love to explore that further with him, but I think those are some of the key benefits, and I think it's also probably tapping into the outsourcer's experience and expertise gained across its client base. I think that's very important as well.
And Tony, would you say there's any other benefits to outsourcing?
Yeah, I would put pure cost reduction fourth or fifth on the list of aims. Actually, I think as you mentioned at the start, that it is difficult actually to take cost out quickly against outsourcing. The first one first top of the list, I would echo what Tom said about risk. See this as a way of reducing risk and giving parts of the process to experts in it that you partner with. The second big benefit, and certainly for a firm like mine, where we're stuck in that sort of funny space of we're not really big, we're not really very small, is the partnership benefit of working alongside somebody who potentially has a lot bigger R&D benefit, or has got 4 other clients who are bigger than you, and they are demanding that we go in a certain direction. You go, that'll work for me because I don't have a big enough voice on my own. So, and I would almost expand that to, I think the trick as an industry that we miss at the moment is in the technology space is, I as a relatively small firm would love to work with a technology provider that's also working with a massive firm with loads of clients that are using, say, their app, and they're using all their client data to develop their app. And I'm like, great, do I get the same app, please? Because I don't have enough clients to get enough volume of data to make that sort of development frequency. So I think risk would be top of my list, and then the agglomeration benefits, if you like, of piggybacking on potentially a combined set of resources to solve certain problems.
Thank you, Tony. And Paul, other benefits that you would like to add?
Yeah, my number one was driving change internally, and I think that's probably the biggest issue for me. That we we use that process of outsourcing and all that means as a team event to get everyone used to this process of change, which will not go away and arguably is going to get much worse and much faster. And I think all our colleagues will feel better for it as well, because it's far more interesting in terms of their career development and so on. There's lots of learning, as Tony said, from an external source. Doing things quicker and slicker is a lot more satisfying. And last but not least, the customer will enjoy it. I mean, that's crucial. At the end of the day, it's that man or woman that we're trying to please all the time and keep them loyal. And that's one of the ways you do this process.
Okay, well, just looking at the time, I'll make this the final question. Now, we're often talking about relationships in this industry, normally between the firm and the end investor. But sticking with the theme of outsourcing, so what steps need to be taken to actually, from both wealth managers and from the outsourcers themselves, to create a positive working relationship that maximizes the value from this partnership? So I'll start with you, Paul, on this one.
I've got, 5? Search for personal chemistry, make sure you can work with the people, because you'll go through some very rough times and interesting and enjoyable times. Agree shared aims and objectives, make it clear and be abundantly clear over the whole cost issue. I would go as far to say I want to know what margin someone's making from the business that I'm giving them. A massive and comprehensive, a comprehensive internal communications exercise. So it isn't something that's kept in a little cabal and no one else in the business knows about it. It's something that should be shared with everyone, even to the point where if people put their hand up and say, well, why can't we do this? Well, I would think that's a big win. Take time out to work literally how to improve creative capacity. It gives you the opportunity to use people in other areas, and rather than lose them and downsize from that point of view, put them to more profitable use. And if anything, I think my big tip would be start small but think big. As soon as you do something well, regardless of how small it is, then it gives everyone a massive degree of confidence to do gradually bigger things, basically.
Okay, and Tom, what steps do you think need to be taken?
I think Paul's covered it pretty extensively. I think I would echo a few of those. I think the absolute starting point is that point around establishing a clearly identified set of common goals, so everybody knows what it is that they're looking to achieve, what the benefits are going to be, throughout the organization and for its clients, as was said earlier. And then I think, linked to that is, as Paul also said, really, it's the maintenance of that. So where does that come in? That comes in with, I think it's the communications, absolutely key. And that's both, within the firm that's outsourced. It's the outsourcer understanding those business goals and drivers at the wealth manager. And I also think there's a part of this as well, which is, the piece I mentioned earlier, which is that the firm that has outsourced needs to know and feel confident that it's retained its voice, even if it's become that sort of, one of many, and that, there is that facility for ongoing innovation within that relationship.
Okay, and last but by no means least, Tony, any steps that you would add?
I think the outsourcing firm has to accept that the person, I echo exactly what the guys said about, partnering and making sure you're aligned and you understand each other's goals. And it links back to what we said about being clear about what you actually value. As the firm that is outsourcing, you have to be, it almost sounds silly to say it, but you have to recognize that the outsourcer isn't going to do the process the same way you used to do it. They're going to do it in a different way. And therefore you've got to be very clear about the bit that's important to you. And if it's important to you that they do it quickly, then they may do it in a different way. Or if it's important to do it correct 100% of the time, then it may take longer. You've got to be very clear about the bit that is vital to you, and not. I see a lot of battles that, Tom, I'm sure you see these, where essentially the firm outsources, but then tries to teach the outsourcer how to do the process, and it's almost the wrong person is teaching in that instance. You've got to take a little bit of risk and a little bit of trust, and say that these guys are going to do this process a different way. But I've defined what success looks like for me, and I have to trust them to try to deliver it.
It's the definition of the success metrics.
Okay, well, seeing that it's 5 o'clock, I'll draw the panel session to a close now. So thank you very much to each of you for your very detailed responses and your open honesty about it. And also thank you very much to our two presenters earlier today. So to Tom Thwaites from Compeer and from Jim London at SEI. Also, thank you very much to each of you for logging on. And so if we move on to the next slide, we do have a few other webinars coming up towards the end of this year. So a couple from our parent company, Parkwell, looking once again at scalability and also building diversity in the wealth industry. And then towards the end of November, we have our own Clients View webinar where we are interviewing 500 affluent and high net worth investors, looking to see how their expectations have evolved. So you'd all be welcome to attend those. We very much hope you do. And until then, thank you once again for listening, and wish you a good night.
Thank you, James.